Hello everyone, welcome back to another video on Erit Academy. So welcome back, and today also we have taken very important question, and it is also from the exam which was conducted by UPSC on 10th April, and this is a question which we can categorize from economy, and also we can categorize it from current affairs. So the question is, recently the term two-pillar solution or the two-pillar package often seen in the news refers to what? A, B, C, D. So it is energy security, or related to cybercrime, or related to global corporate tax, or is it related to prevention of international money laundering? So we'll see the answer, but we have to understand that how did we reach till two-pillar solution? What is the story behind? Then only we will get the conceptual clarity, and we will also understand that how much focus should we give to such information, in what depth we should read. Okay, so let's start. So today we are living in the era of digital globalization. With the globalization of economy, the multinational enterprises are setting up businesses across the globe. They're not worried about the brick and mortar model. They're operating online. They are using internet. They are using e-commerce. Various technologies are there: artificial intelligence, blockchain technology. So many technologies are there, and they are easily managing the businesses, be it services or the production of goods or anything. So in such scenario, levying tax in multiple countries becomes a huge challenge, and the MNCs or the individuals, the investors, they start taking the benefit of such loopholes or the gaps or the challenges, and they start doing tax evasion. So in order to check tax evasion, time to time, countries have taken actions at the national level, at global level. We have come up with Double Taxation Avoidance Agreement, DTAA. It is basically a tax treaty which is signed between two or more countries. It is signed with the objective that the taxpayer in these countries can avoid being taxed twice for the same income, right? So a DTAA applies in case where the taxpayer resides in one country and earns an income in other country. So that is the Double Taxation Avoidance Agreement. Countries have also come up with transfer pricing. Transfer pricing refers to the prices of goods or services that are exchanged between companies under common control. For example, let's say if subsidiary company sells goods or renders services to its holding company or a sister company, then the price charged is referred as transfer pricing. So the best practice will be that it should be practiced at arm's length pricing, at arm's length, without any interference. But that doesn't happen. So it is being used these subsidiaries are being used for tax evasion. So time to time, tax authorities will come up with rules and regulations. We have come up with POEM also, that is place of effective management. Basically, it has been defined to mean a place where key management and commercial decisions that are necessary for the conduct of the business of an entity as a whole are in substance made. So basically, it is a framework which was introduced in 2018 to determine the tax payable by a foreign company for all purposes is managed from India and yet does not pay taxes domestically. So where is the place of effective management happening, be it wholly or even in substantial mode? So on that basis, a tax evasion, if it is happening, will be checked. So that was POEM. Companies are going for treaty shopping. So treaty shopping basically involves the attempt by a person, let's say if a third person is there, they are trying to use the benefits of a tax treaty between two jurisdictions, between two treaties, between two countries, without being the resident of any of those jurisdictions. Let's say if the investor is of USA and they are trying to get benefited from the tax treaty between India and Bangladesh, even though they are not resident of India, they are not resident of Bangladesh. They are just trying to take the benefit of the tax agreements. Okay, so because of this globalization and digitalization, especially of delivery of services and goods, it is adding complexity. Even very recently, India has come up with Equalization Levy. So Equalization Levy was introduced by India in 2016. and the intention was of taxing the digital transactions, that is the income accruing to foreign e-commerce companies from India. So it was aimed at the uh, taxing business houses, basically business to business transaction. And remember, equalization levy was imposed under Finance Act 2016. It was not part of Indian Income Tax Act 1961. Okay, so it is a kind of direct tax. And there were conditions also that is not important for us, and separate legislation was introduced. Why I'm telling you in this much detail? Because UPSC had asked question in 2018, and this is the question on the screen. The question is with reference to India's decision to levy an equalization tax of 6% on online advertisement services offered by non-resident Indians. Which of the statement is or are correct? So the first statement, it is introduced as a part of Income Tax Act. No, it was the part of Finance Act. So that is wrong. So 1 and C both are out. Now we have B and D. Non-resident India entities that offer advertisement services in India can claim a tax credit in their home country under double taxation avoidance agreement. So it is talking about claiming tax credit in the home country. So no, it was under this, and the companies, they cannot claim a tax credit in their home country under double taxation avoidance agreement. So this statement is also wrong. Now why I'm discussing in this much detail is I want to make you understand that, see, this was one term, and while discussing the whole story, I focused on equalization of levy, equalization levy, which was introduced by India. Now see the depth of the statement which has been framed by UPSC. So one statement is simple, that from it was introduced as part of what, but the second statement, if you don't focus on the concept, if you're not familiar with the concept, then you cannot handle. So this is the question, even though it is very shallow, but we should know. So this depth is, one statement is shallow, one statement is having depth of conceptual understanding. So while preparing such key terms from economy, current affairs, keep in mind that you should understand the concept. So this is about the equalization levy. So this way, time to time, countries have been coming up with the regimes, laws, rules, regulation, international cooperation in order to check the tax evasion. Okay. Now related to tax evasion, this is one word which is, the full form is base erosion and profit shifting. This we will discuss it in detail. This concept was given by OECD when OECD observed that okay, a lot of tax evasion is happening, then they wanted to address this base erosion and profit shifting. Okay, we'll discuss in detail. First, let's discuss about OECD. What is OECD? It is Organization for Economic Development and Cooperation, and with a member of 38 countries, with a membership of 38 countries, and it was founded in 1961. Headquarters is in Paris, France. India is not a member, remember it, but India is a key partner. And one of the important report which is released by OECD is International Migration Outlook. Right, it was founded in 1961, we have discussed, and the overall objective is to shape policies that will help in the prosperity, equality, and opportunity and overall well-being of the member countries. Okay, and over the years it has been working in order to address the issues related to economy, expansion of the world trade, and promoting economic stability. Also working on raising the standard of living of the member countries. So basically these countries, as you can see on the map of OECD map, which has been shown on the screen, the blue areas highlighted on the screen, they are the member countries of OECD, and they are basically those countries which fall under the high income economies, or they have high human development index. So basically we call them as developed countries. Okay, and the observation, basically OECD can be categorized at, or we can say it is a think tank which will work on the economic issues, and they get time to time they come up with certain recommendations, observations, reports with respect to global economy. So OECD's reports have been given more importance by G20 group. So G20 group is an intergovernmental forum where 19 countries and European Union, one European Union, they are the members. So their agenda is also to address major issues of global economy, including the international financial stability, climate change mitigation, and sustainable development. When we talk about G20, so G20 was founded in 1999 and also 2008. Why I am saying so? Because G20 it came in 1999 after the Asian financial crisis, and at that time the finance ministers and the central bank governors they started meeting. But after the financial crisis of 2008, when world saw the need for new consensus building at the highest political level, then it was the time when the G20 leaders, the presidents or the prime minister, they started meeting, and then it was decided that they would meet once annually. So this is how G20 endorses OECD or supports OECD's observation, and we have discussed that what is the role of OECD. So recently, a few years back, India has ratified the multilateral convention tax treaty related to the measures to prevent base erosion and profit shifting. So we call it multilateral instrument, MLI. So it was the outcome of OECD and G20 projects to tackle BEPS, that is base erosion and profit sharing. Now we will discuss what is base erosion and profit sharing. Now let's have a look at base erosion and profit shifting, BEPS. So this term includes, basically it is the abbreviation of four words, that is B stands for base, stands for erosion, and P stands for profit, S stands for shifting. This in turn refers to two common practices for multinationals to lower the taxes that they pay, notably the corporate tax. So this, out of this, BE is a domestic tax base erosion. So basically, whenever we talk about base erosion, so what kind of base is getting eroded? So domestic tax base is getting eroded. It refers to the practices of reducing the taxable base. For example, it is deducting the large interest payment in order to lower the taxable profits. So that is how base erosion is happening. It also includes, this word has PS, so it includes profit shifting, which means the practice of shifting taxable profits from high tax countries to low tax countries. For example, let's say transfer of ownership of intellectual property and its income from US, that is a high tax country, to Bermuda, that is a low tax country. So this is how this practice is being done, and people are using it to evade taxes, and countries are losing on it. International organizations like OECD have labeled this BEPS as major issue, and this led us to the other way in which word like BEPS is often used. Okay, and it is done to minimize the corporation tax, and people are disappearing or shifting the profits to low tax jurisdiction where there is little or no genuine activity. However, we cannot say that it is not illegal. The strategies are not illegal, rather they take the advantages of different tax rules operating in different jurisdiction. Okay, and if we, according to OECD's observation, this BEPS practices cost countries across the world, it is costing around 100 to 240 billion loss of revenue is happening annually. This is annually 100 to 240 billion loss is happening. Okay, by the way, we should not discuss in that much depth. However, if we don't discuss, then we will be not able to remember it. Why this question is important, why I'm discussing is because UPSC has already asked a question on BEPS in 2016. So here is the question. The term base erosion and profit shifting is sometimes seen in the news in the context of what? So options are A, B, C, D. Let me tell you the right option. It is B, curbing of tax evasion by multinational companies. Right? So even in such cases where the keywords are of global level and they are the concepts basically. So if we are familiar with the concept, we can reach our answer. Definitely we don't have to do research for every topic, especially for UPSC. We should not do our research. But if we know the information at the shallow level also, we know the context, in what context we have read it, in what context it has been introduced, we can easily reach the answer. So that's why we need to know the story. Okay. So this OECD has come up with the BEPS package where it has given up 15 actions for the domestic and international instruments in order to tackle tax avoidance. So as BEPS version 2.0, that is BEPS 2.0, now OECD has come up with two-pillar approach. We'll see that in detail. So OECD has come up with two-pillar approach. What is that two-pillar approach? Basically, this is one of the ambitious proposals that seeks to fairly determine, it is based on the principles of fairness, so fairly determining the tax base and also the method of taxing multinational enterprises in the digital world, where they will be able to pay the taxes at right places, basically right countries. So this idea was finalized by the countries, around 137 countries under the aegis of OECD, came up with this statement on two-pillar solution in 2021, and this will be enforced, it will become effective from 2023. So what is two-pillar solution? So when we talk about two pillars, so the pillar one is basically proposing that market jurisdictions, basically if there is a firm which is operating from USA and they are US based company, but their market is in India, they are operating in India. So pillar one is suggesting that market jurisdiction should be entitled to tax some of the profits generated in that country. So whatever tax profit is being generated by that US based company in our country, in India, then India should be entitled to tax some of the profits. So the aim is for the multinational companies to pay some tax in the countries in which they are doing the business. Okay, and not just where they have their headquarters or established the corporate entities. So basically the idea is focusing on distribution of the taxes. It is focusing on better distribution of the taxes, reallocation of some taxing rights over MNCs from their home countries to the markets where they have business activities. Okay, and they are earning the profits. Even according to OECD, more than USD 100 billion of profit are expected to be reallocated to market jurisdiction each year. So countries like India, the developing countries, they will be benefiting from this pillar one. Okay, because market jurisdiction or the countries will have the say in levying the tax. The second pillar aims at controlling tax competition on corporate profits. Basically, it seeks to put a minimum standard tax rate among the countries through a global minimum tax. Basically, it is a corporate tax of 15%. Currently, it has been proposed at 15%, and it is about minimum tax and subject to tax rules. OECD is expecting that it will be able to generate an additional $150 billion in tax revenue globally. So basically, the structure of pillar one, pillar two pillar solution, two pillar strategy is a framework which seeks to address the tax challenges arising from digitalization of the economy. And India has already levied equalization levy. So India might have to roll it back, but it justifies India's stand for greater share of profits for the market. So hope you enjoyed the discussion and you have understood the whole story behind it. And this way you should also prepare. Take a concept, know the story behind it, at least know the theme, then only you can reach the answer. Okay, friends. So take care, revise well, and we'll meet again in a new video with new topic. Take care. Bye bye. Have a good day. Okay, wait. Before signing off for the day and before I say goodbye, let me tell you the answer of this question. Let's read the question once again. So the question is, recently the term two-pillar solution or the two-pillar package often seen in the news refers to what? So the answer is minimum global corporate tax. So I hope now you know the story. It is not related to option A, that is global energy security in near future. It is not related to option B, international cybercrime reporting. It is not related to option D, prevention of international money laundering. So it is related with minimum global corporate tax. So basically it is talking about pillar 2. It is not even mentioning about pillar 1. Okay. So hope now you have the better clarity, and now we can sign off for the day. Take care, friends. Bye bye.